Back. What I've learned from yesterday is if I keep talking, normally at some point people start to get quiet.
The shushing.
Yeah, we won't do the shushing. No, thank you for everybody for coming back and for the participation yesterday. Could be it.
Is your mic on?
I think,
Can
is it
everybody
on?
hear us okay? This is good? We're going to get started, so if everyone could just take the volume down, thank you.
Can everybody hear me okay? It seems okay. That was very silent. That might mean no one heard me, but okay, great. Thanks everyone for coming back. It was great fun yesterday. Really looking forward to the session this morning. We've got a fireside chat coming up with Nate in a few moments. After that, a second fireside chat with Andreas, who's a private investment manager, and then finishing up with the panel discussion with, I think, some great panelists later on. But Nate, what a privilege to be interviewing you for a change. I think we met probably about 7 or 8 years ago when I was towards the start of my career as an investment manager. I think you were probably towards the start of your career at MIT as working at the endowment there. So I guess our kind of journeys have moved in parallel. And I think normally you're the one questioning me. I think if anyone would care to go back into the archives, there's a fireside chat a few years back when Nate interviewed me. So this is the first time I get to interview you, so that's a really a great privilege. So you've obviously been working, I think you mentioned, for about 10 years at MIT, and I've known you for a large portion of that time, and what's really struck me about you is your thoughtfulness, which is not unusual in this industry, but also your kindness. You're one of the kindest people I've ever come across, and I actually spoke to one of your colleagues a few years ago, and he was tasked with, in the process of hiring you, with going through all of the character references for you, and he told me they were completely off the charts. He'd never heard such positive feedback. So what I'd like to do today is go into a little bit to your character, where you come from, who is Nate, and how did you kind of choose to work in an endowment, and of all the endowments in the world, MIT. So that's where I hope the conversation is going to head towards. But let's start with who Nate is prior to kind of working at MIT and that kind of stuff. Tell us a little bit about yourself.
That is an extremely humbling start. Thank you for the kind remarks. It's a great pleasure to be here. It's a lot of familiar faces in the audience, so thank you for bearing my personal story for the next 45 minutes or so. And thank you for bringing everyone together. This is a really special event that brings, as you say, a lot of really thoughtful people into the room in an absolutely stunningly beautiful place. And so we're all owe you a round of applause for bringing this together for us. So as a starting point, how far back do you want me to go?
So maybe some of your activities, what you studied, what your kind of interests were before kind of entering the working world.
Sure. So I mean, I think the hub of it all is I was raised in a very loving family, very modest background. Investing was not the dinner table conversations in my home. We didn't read the Wall Street Journal stock charts on Sunday morning. So I came into investing later in life, around university. I have always had part-time jobs really since I was 14 years old. So I had a smattering of jobs. I was a camp counselor. I was a ski instructor. I worked at a sandwich shop. I was a tutor. And I think that sort of early on showed a little bit of intellectual curiosity and wanting to try a lot of different things. And I think that's a really
probably
important.
Also exposed you to people from all kinds of walks of life.
Yeah, I think it taught me early on like how to talk to strangers, at age 15 and having to deal with customers and meeting lots of different people in the tutoring room at university. You just have to be able to build rapport with people very quickly. And I think in this business, sitting in a seat where we're investing our capital to outside managers, you have to have that capacity to, sort of warm the bath, as one of our investment partners say. So early on, that was part of the experiences that were formative.
Yeah. So what did you study then?
So I studied economics and finance at university. After leaving, I joined a firm called Cambridge Associates, which is an investment consultancy to pensions, family offices, endowments, and foundations. And I actually started in more of an operations role, more kind of fund accounting, and we built the benchmarks that went into the private equity industry. And I knew very early that was not the right role for me and the right path. So I can
So how did you end up in the first? Was it kind of like they were doing the rounds in university, and that seemed like what kind of led you to take the job?
There wasn't a particular moment where I said, this is the place, these are the people. That came later, and when we get to the MIT story, I think that's very central. Yeah. Sort of a young man finding a great opportunity and saying, I don't quite know what the next 5 years holds, but this is a wonderful firm and a wonderful opportunity in a place where you could build a brand and get a little bit closer to institutional investing.
So what didn't you like about Cambridge Associates then?
Borrowing a page from your book, it's helpful not to say bad things about people. No, I think it's an extraordinary firm. It was more the role than the organization. Yeah. So I was much more focused on, digging through financial statements of private equity partnerships, and it was sort of the texture of the work wasn't right for me. It was sort of sitting at a desk, head down, versus engaging and interacting with people. But I can remember a distinct moment where it was actually on a company ski trip, so that's another theme, where we talked about, people talked about their various futures, and it became very clear to me in seeing the Cambridge ecosystem that being able to invest for the benefit of a foundation or an endowment, where you can invest for impact, and all the profits that you're generating are being reinvested in a place that has an extraordinary impact, that clicked very quickly, 6 or 9 months into the experience. I then went on to graduate school, worked at a public pension fund in Utah, and around probably the fall of 2009, in a stroke of wonderful luck, was put in touch with the MIT endowment, interviewed over a course of 3 months. And
so how did that come about? Tell us what was the stroke of luck that kind of created that contact for you?
Having grown up in the Northeast, I'm Boston born and bred. My girlfriend at the time, now my wife, came out to Utah with me. We did quite a bit of skiing, again, theme.
Skiing is definitely a recurring theme.
It just sort of felt like time to move back to family and roots, and if we were going to start a family, that would be the place. And so I just went out to my network and said, hey, I plan to be back in Boston in the not too distant future. And a good friend, Tim Wynn, who was at the University of Connecticut Foundation, said, you must meet Seth, period.
Seth is the
CIO or the president of MITIMCo. I'll talk more about him in terms of a lot of different things. But put my name in the hat. Was extremely lucky to have received some interest from them and interviewed over the course of 3 months, and joined in May of 2010.
Yeah. So what type of an organization was MIT when you joined, the endowment when you joined?
Sure. So MIT has had a formal investment operation dating back really into the sort of 1980s, even further back. MIT is a 150-plus-year-old organization. The capital is permanent. MIT can take an extremely long view of its investments. And so that's, I think, always been core to the way they invest. But the office became more formalized in the 2000s, and then Seth Alexander joined from Yale in 2006, having worked at the Yale Endowment for 10 years. And at the time I joined, the team was building. There was a group of people there, but the philosophy was becoming more crystallized around the way Seth likes to invest. We had the desire to add more bandwidth to the team to cover more of the globe in terms of finding great investment opportunities. So when I joined, the team was really churning and growing. And so I joined alongside a crop of really, really bright people, and feel extremely fortunate to have started when I did. Many of you have probably met my colleagues like Joel and Matt and Ryan and Nav, who's here.
Nav, do you want to quickly stand up? I know.
And so, the contours of how we work is very team-based but autonomous. So we almost operate more like a venture partnership versus a more traditional, vertically hierarchical, organized firm. And the idea is find the best athletes in the best opportunity sets globally and deploy MIT's capital to those partners with the view of having 10-year plus, relationships that are measured in decades, not years. And so to your question, when I was starting, that was sort of the mandate right from the outset. It was not, okay, you're going to apprentice for 2 years and then we'll decide whether or not you'll promote it into a new role. It was, here's how we operate with our travel agent, go out and find great ideas. And that was just extraordinary for me.
So it sounds like you were hired around the time Seth was sort of coming on, or shortly afterwards, where there was a lot of change happening. He was putting people in who were his kind of guys, investing his type of way. Maybe you can kind of describe some of the key features of how back then, he wanted to set the endowment up, and in particular how to choose investments. Mm-hmm. And then I'm going to ask afterwards maybe how things have evolved and changed since then. Yeah.
Sure. I think in 2010, the effort was really looking at the asset base and saying there's a lot of room for improvement to create more tension in the portfolio and to upgrade the roster. The capital markets felt a lot different in 2010 than they do today, in the sense of having come out of the global financial crisis. And so it really was a mandate to go out and source and find the best talent.
Irrespective of geography, asset class, or were there any kind of preferences in terms of what type of investments?
Sure. So I think at the core, there's an investment philosophy around who are we in terms of what sort of risk and reward do we think are within our circle of competence, and what can we underwrite. And so it's very clear to us that what aligns with our interest is fundamental investing. And so people who look at the world bottom up and feel that they can underwrite microeconomic situations, whether it's a C+ building that can be converted to an A+ and sold at a lower cap rate, or whether it's someone who looks at businesses globally. We're trying to focus on assets that we can understand. And so that's been very constant through time. I think the changes that have been made is we've evolved beyond a more conventional asset allocation framework where we say, here's the international equity bucket and the Japan bucket and the private equity bucket, and let's fill those up to target allocations, and rather say, let's just find what we think is the best and have a risk framework where if we wake up one morning and 10% of the portfolio is in Turkey, we may be overconfident in our bottom-up estimate. Yeah. And so that really started to crystallize around 2012, 2013, with a lot of communication with our board of directors in terms of what this means and why it might be different than other endowment pools. Yeah. And so in concert with that, if you have a team that's structured around a particular asset class, so if I'm a credit person, my job is to go out and find credit, and I'm going to bring you the best thing I see from my vertical. That may not compete with what a colleague of mine might be seeing in equities in India, for example. And so to match the asset allocation framework, we took away the asset class silos, which was previously public markets, private markets, and real estate. And everybody dropped their titles and took on the generalist title. And I think that really energized the group to say, we can now invest in a way that more purely reflects the way we allocate capital.
Yeah. I mean, that's one of the things I've appreciated from my contacts with MIT is, Seth, who's obviously a pupil of David Svensson, probably the most famous endowment CIO there's been. And Svensson was, of course, famous for sort of being unconventional, and at the time investing in hedge funds, which endowments didn't do. And my sense for a lot of endowments that copy Svensson is then they kind of have a big hedge fund allocation. But that wasn't Svensson's message. His message was be unconventional, right?
That's absolutely right. I think if you want unconventional returns, you have to behave unconventionally. And so for us, I think it was the asset class focus, the generalist focus. And I think being a bit aggressive about this is our circle of competence and we're not going to go outside of it. So I think there's a lot of very strong marketing forces in this business that bring you the latest and greatest idea in portfolio construction and long volatility strategies. And I think it was very clear as a group, this is what we think we're good at and let's stick to it.
Yeah. So going back to your story, so you arrive in 2010, I think you said. Did it kind of click immediately, this is the way to do things, or was there a kind of a personal journey for you of kind of with certain milestones and building conviction on this is how to do things?
Yeah, so I spoke with an endowment CIO the other day on a reference, and she asked me, when did you start to really get it? Were you the type of person that was reading the Buffett letters in middle school? And the answer is no. And I think not long after starting the interview process with MIT, I asked Seth if he had any book recommendations. Mm-hmm. So I was probably 24, 25 at the time. Mm-hmm. And he said, yeah, absolutely. And so within, minutes, I had an email list with common stocks, common profits, intelligent investor, quality of earnings, which is an interesting old one, and a handful of other books, the Jason Zweig book. So I started reading the sort of value investing canon as I was preparing to join, and that's when the light bulb went on in terms of, you know.
You hear that so often that either the light bulb goes on or it doesn't, and there's no amount of reading you can do if the light bulb doesn't go on.
Absolutely. And then to immerse yourself with a group of people who all think the same way and have come to these insights around the same time. Yeah. And the texture of the conversation is through that lexicon. It was, it's very absorbing and consuming.
Yeah. And I know many of your colleagues, and I can imagine, like you said, you all kind of started at the same sort of time, have similar sort of ways of thinking about the world. I can imagine it was an intellectual journey which you kind of all went on together, but also kind of helped each other on.
Absolutely. And I think the nature of our work, if you were to walk through our office, it's a bit library-like. There's a lot of reading, and we get into arguments in the hallway. But there's not a lot of people standing and shouting into phones. It's a lot of contemplative work, a lot of writing and reading. And it's just an extraordinary environment to be in. Once you come in the morning with your coffee and someone pops their head in your office and says, have you read this, long-form piece on stratechery about, such and such? And we're a learning organization, and I think it's really powerful to be in that. And I think it informs how we invest and the type of people we want to underwrite and partner with.
So were there any, and maybe this isn't the case, but were there any either kind of very negative or very positive experiences over the last sort of 10 or so years which really kind of either changed your mind about something or kind of firmed you up in your beliefs about the way you want to allocate capital?
Yeah, I'd actually go back a bit further.
Okay.
I worked, as I said, at a pension fund in more of an analyst role, but allocating capital to managers starting in kind of 06, 07. And so we were constructing a hedge fund portfolio into 08, 09. Yeah. So I learned some very powerful and visceral lessons in leverage and asset liability mismatches in these hedge funds that had quarterly liquidity and had gone way out on the liquidity spectrum in their portfolios to juice returns or had used a lot of leverage. And so saw some pretty spectacular failures from arm's length. I think they were well sized. And so that was very powerful. And I think coming into MIT with a few battle scars and having worked through a few hedge fund liquidations was really helpful.
What an amazing experience as a bystander.
Yes. I think the footnote on that is all of the equity capital that was used to fund the hedge fund portfolio at the pension, was like a beta of one, full equity risk, and so that went into a hedge fund portfolio that saved probably billions of dollars despite some blowups. So that was an amazing experience. Just in terms of MIT. The culture of just saying get into the field and do the work, meet whoever you want to meet was very powerful. And so to just have this broad canvas of meeting great people, many of whom are in the room. It was meeting you in 2012. That framework I think was really impactful. But in terms of very specific milestones that I think inform how I invest today, it feels much more like a gradual path than a few step function moments where you say, wow, okay, everything is much clearer now.
Yeah. I want to return to your personality. So everybody that knows you will say you have emotional intelligence, which is really off the charts. And that's not something that's necessarily associated with kind of finance stuff. And maybe you can talk about how that's sort of how that sort of impacted you as an investor, and how that's maybe differentiates the way you kind of choose investments from perhaps someone who takes a more kind of strictly financial or economic type approach.
I think my approach works in the context of a team. I think it's very helpful to have empathy and to connect with people and to have a better initial filter for someone's integrity. And I think my experiences have led me to that style where I can connect with people. But I also think that can lead you to make mistakes. And so it's great to have colleagues who are maybe a little more focused on the objectiveness of the assets themselves, and they're less skewed by personality type. Yeah. But I think it's relevant because ultimately we're forming resilient relationships with our partners. And so we allocate initial capital after some diligence, and there may be opportunities to build the position over time. But ultimately, the relationships will be most valuable in the most difficult times. So difficult capital markets where there's an opportunity to deploy additional funds or to make a very difficult sell decision because the assets that have been marked down are actually worth much lower prices. And those are difficult conversations to have. And I think also as investors that build businesses and run partnerships, they face difficult challenges in personnel, in growing the business and starting to run another vehicle, or various things that happen throughout the course of a firm's existence. And we want them to trust us and to come to us as a sounding board to say, hey, we're thinking about this path. You all have seen this many, many times. We trust your input. And so I think we're very much trying to position ourselves as partners that can be trusted sounding boards, not clients.
Yeah. There was something you said in there which I'd like to maybe go a little bit deeper on. And you talked about, finding or discovering integrity in people. And it sounded like your path to do that was one of more kind of through kind of, emotion and connecting as opposed to kind of the brain, which is a subject which is dear to my heart. Maybe you could talk a little bit more about that.
I think it's a combination of the brain and the heart, to be fair. I just think I enjoy learning more about people and learning more about their passions and what makes them tick and what their motivations are. And ultimately what we're looking for are people that are exceptional at what they do for a variety of reasons, which is a longer conversation, and who are going to be excellent stewards of MIT's capital.
Yeah.
So we have to know that we're building a relationship born out of this person in the worst of times is going to act in the best interest of MIT.
Yeah. So how would you respond? I think there was a question yesterday which went in a little bit in that direction, that to someone saying, Nate, this is a disaster. You need to be 100% rational in judging these things. If you start letting emotions interfere in any way, you're going to kind of get hoodwinked by the wrong person or whatever. To what extent do you think that approach any approach is going to lead to mistakes every now and again, but what makes you think that approach could be potentially superior to a kind of a much more kind of a kind of economic sort of rational type approach?
Yeah, I do think that a economic rationality permeates my decision making. So I don't want to say that I'm purely driven by listening to some empathetic reasoning. I think it's a combination of both. I think when you're perhaps too hyper-focused on rationality, you may miss the nuance of what someone's going through, and whether it's a bad period of performance or something they're going through in their business, you may need to be a lot more patient versus becoming immediately very commercial in a situation. But that's not to say that I don't personally make decisions with a commercial orientation, because ultimately our job is to grow MIT's assets so that we can support the spending and the purchasing power in real terms over time. So I very much have to be thinking through the economic lens when I'm making decisions as well. And if anything, one of the things I have to focus on is making sure I can temper empathy and balance commerciality at the same time, which can be a difficult tension. I'm not sure if I'm answering your question, but
no, it's fantastic. So fast forwarding to today, there's a lot of younger managers in the room here, emerging managers, and they would probably love to hear how you think about assessing younger managers. And I know you probably want to be a little bit careful in your response, because you don't want to people just to copy one for one what you're looking for. But I know your model firsthand, and irrespective of whether someone gets an investment from MIT, I think they should be setting up to attract people like MIT. So maybe you can talk a little bit about the kind of characteristics and qualities you look for, especially in the sort of less developed or managers. Yeah.
Sure. I think so. We're very, very happy to be with people early on in their evolution as investors. We also make investments with people that have long track records and a lot of experience and more mature businesses. So we invest across the spectrum. I think with younger people, we're looking for, and it doesn't have to be younger. It's not about age. It's about younger.
I consider myself a young person, just to clarify.
Me too. I think we're looking for clarity of vision. What are you really aspiring to do with the pool of capital that you're tasked with managing? And that doesn't mean some hyper-focused, pinpointed, dogmatic, only small companies in the UK with a market cap less than 300 million that are in these sectors. It's not about narrowness of the universe definition. It's clarity in what you're seeking to spend your time on in certain regards. What businesses are you drawn to when you construct a portfolio? What is the sort of texture of the portfolio you're trying to build, and along what dimensions? I think we're trying to spend a lot of time on personal motivation as well. Why are you in this business? What motivates you to get out of bed every day and read that 10th 10K of the week or whatever it may be? I think we're trying to find people that have some connectivity to our mission and who understand that, luck on our side, making $1 billion for MIT is just an extraordinary thing in terms of contribution to society. And so, that's not the overarching goal, but I think people need to understand their fiduciary duty.
That there's a purpose.
Exactly right. I think we like to spend a lot of time on how people think and how they form judgments. And I think that's really the thread that connects all of the work that we do. We're evaluating how you think about a company, a management team, how that fits in the context of a portfolio. What is the threshold for quality in your mind? What is the threshold of what you're willing to pay? And there's no right answer to any of that. It's a mosaic of experience and insights. And so you've had the experience of sitting with us, and others in the room have as well. It's really about understanding decision making and the durability of that decision making through time. And I think that comes down to how you process information, how you analyze information, and behavior as well. And so what is this person's temperament? How are they going to behave if they're down 30%, 40%, if a stock's down 50%? And we set up these a priori views of what we think to be true, and then we monitor them through time as to whether or not the hypotheses we've constructed are correct.
I mean, it's amazing. As I was listening to your answer there, it seemed like 80 or 90% of the characteristics you were looking for were ones of kind of character and temperament, and as opposed to kind of raw mental processing power.
I think raw mental processing power is definitely an input, and we spend more. And again, across the team, if you were to have Matt sitting here, or if Nav were sitting here, you'd probably get, a different weighting of the ingredients, right? Like I make a sourdough bread, and maybe Nav doesn't eat bread, but he makes sort of the beautiful whole wheat bread that I had for breakfast at the hotel this morning. So same ingredients, but different weightings. And so others may be more hyper focused on the way somebody calculates a particular retention metric on a SaaS business, and I appreciate that, but I may be more cued in on other things. And I think that we work in teams of 2 or 3 or 4 on investments allows us to make better decisions as a group, because I'm going to cue onto something and someone may cue onto something else. And I think while we don't make decisions by committee, we're able to work in sort of powerful small groups to make great decisions.
It really is a great team, and I could definitely kind of vouch for that. You kind of really seem to all complement each other.
Thank you.
Maybe a question to finish up with, and then we'll take some Q&A from the audience here. How do you see the endowment at MIT developing over the next sort of 10 years? Do you think it's perfectly set up now? Are there things you'd like to change? How would you like to develop the endowment, or yourself personally? What's your kind of 10-year plan?
That's an excellent question. I think I would paraphrase the way you answered a question yesterday about most difficult challenges, and just this concept that performance is in the past. So if we've done well, and we've done well as a team, and we've made some good decisions, that guarantees nothing about the next 10 years. I think we've built a durable portfolio that will serve us well, but we need to always be front-footed in thinking about where are the risks in the market that we don't understand? Where are the opportunities that are most compelling? Is the team organized in a way that's most productive? I think our challenge is we manage a lot of capital. We have over $25 billion today between the endowment assets and the pension assets as well that we manage. It's hard to move the needle on a pool of capital that's that large. So we have to think very critically and creatively about how scale impacts how we invest.
Yeah. Are there any areas of the capital markets where you think you are underrepresented at the moment? Maybe some more kind of unconventional areas, or?
Nothing really springs to mind. And you also asked about personal goals over the next 10 years. We talked about this over dinner last night. I think health and wellness is like core to MIT or MITIMCo's culture and the team's culture. Like, you need to be well rested and energized to do great work and to think clearly. So I think that burning the candle at both ends, we travel a lot, we sleep on airplanes a lot, but having some semblance of work-life balance as a team is going to make us better investors because we're going to make better judgments. So understanding what that means as you get 10 years older and your family life changes and the team changes, I think that's important. And I think efficiency of decision making, and for me, and actually this tension of empathy and being more clear-eyed and economically rational is a tension that I think about, and I think about some of the pitfalls of that. So.
Great. What a wonderful note to end on.
Thank you.
Okay, so we've got about 15 minutes, so we're going to take questions from the audience again, like yesterday. James has very kindly offered to be our Nate for this morning, and he's going to curate any questions that come in over the internet. So if anyone's watching on YouTube, feel free to post a question there, and James will pick the best ones. Okay, who wants to kick off? Right at the back.
Hello, Tim here. Thank you for coming. My question is regarding the future returns you expect in the equity portfolio, maybe your opinion, and if there's an MIT opinion regarding the portfolio, because, as you said, the last 10 years will not be like the next 10 years. Thank you.
The short answer is I have no idea what the returns to the equity market over the next 10 years will be. What I do know is that from our asset pool, we spend 5% a year to fund the university's operations, and that's fully 1/3 of the operating budget of MIT. So at a minimum, we need to earn 5% to do that. And then
to keep the lights on.
To keep the lights on and to sponsor scholarships and cancer research and clean technology research and all these things. And then on top of that, we have to earn inflation to stand still in real terms. So we have an absolute return bogey of somewhere between 7 and 8%, depending on your definition of inflation in MIT's context. So we have to maintain an equity orientation to earn those sorts of returns, both in the public markets and then in the private markets. So I don't know where the equity markets will perform, but we're constructing a portfolio with that ambitious hurdle in mind. It's sort of a non-answer, but that's how we think about it.
Just have to take it as it comes.
If anybody knows what the equity markets will do over the next 10 years, please feel free to raise your hands. Oh, he knows. Thanks, Matt.
Sorry to disappoint you all. So Matt Brown from the Oppenheimer Family Office. So I'd be interested to hear about what you think the key characteristics of MIT are that have really enabled you to be successful in really finding and backing the right emerging manager talent.
I think it's a tone from the top to energize people to believe that it's possible to just find the best. There's no room to settle. Like the task is go out and source and find great people. And I think a lot of our peers who are wonderful investors have the same mandate. And so maybe that's not distinct, but I think that energizes the group to just believe it's possible. I think it's the quality of the people and the fact that the people have been together for as long as they have. So I think the average tenure on the team today is probably approaching 8 years. And so having shared language and shared experience and shared pattern recognition makes a big improvement in our ability to source and triage. I think this point earlier about sort of clarity of what's a fit for us and knowing what we shouldn't be spending time on is just as important as knowing what we should be spending time on. And I think we are the beneficiaries of scale economics and the type of investing that we do, and that having a large capital base allows us to have a large team and to have a lot of global reach. And I think we all benefit from the MIT brand. I think MIT as an institution is an extraordinarily well-renowned place globally. And so we can be in Singapore or India or Sao Paulo and people know of MIT. And so that's a big, big tailwind for us. And they may not know about our endowment or me or a colleague, but they know about MIT and its sort of strategic global importance in solving problems, and I think that's a big help.
While the microphone's moving around, one point I'd also add to that is I think MIT really views itself as a service provider to the managers as opposed to the managers being a service provider to MIT. You provide an enormous amount of support in terms of infrastructure, especially to the emerging managers who might not have it. So I think that's also a source of competitive advantage.
Yeah, to the extent. So we have the investment office is 14 people. We have a phenomenal operations group that is about 30 people that does tech, accounting, finance, data. And then we have a 25-person real estate team that focuses just on real estate development in and around Kendall Square and the MIT campus. And that's basically a vertically integrated real estate manager in-house. And they are unbelievable at what they do. But in the operations group is there to allow our partners to focus on investing, not have to deal with, trading glitches or, other things in the LPA that might otherwise take them, a lot of time and lawyer fees to fix. We can bring that to internal counsel and come back with a quick answer. So thanks for mentioning that.
Okay, next one.
Nate, one of the success factors has been being unconventional. So I would be interested in, is there a way how you can foster having unconventional ideas and kind of promoting, finding new ideas how to invest?
That's a good question.
Also on the allocation side.
Yeah, I mean, to be honest, I don't think anything we're going to do is going to be, enormously and wildly unconventional. I think it's, if you think about sort of the institutional path that a lot of organizations take, it's having the fortitude to be able to look beyond that particular path. And so I think a lot of it is sort of courage to just be different and to appreciate that if you're different, some years you look brilliant and other years you may look very unwise because the fruits of whatever decision you made have not provided themselves yet. So I think it's a bit of courage, a bit of creativity. I think it's the people in the room feeling empowered to think differently and not anchoring to convention. But I don't think there's a secret sauce per se. I think it's more of a cultural value to accept unconventional decisions and to live with their consequences on both sides.
James, are we getting any from the internet? Do you want to chime in with any?
It's okay if you say too many to handle.
Save the hard ones for you. Nate, can you talk about the tension between maintaining a long-term orientation with a manager and seeing them through those difficult times, but also sort of compare that to the fact that the endowment does need a relatively consistent 7 to 8% nominal return per year?
Yeah, I think all of our partners are investing with a 3+ year time horizon in most cases. I suppose someone who's shorting stocks is taking a shorter view and maybe more catalyst driven just because of the asymmetry of shorting. But we have to force ourselves to be patient when evaluating performance and appreciating that a stock purchase decision or the purchase of a private company or a real estate asset will take 3 to 5 years to reach its underwriting conclusion. I think what we do as a team is we try and develop hypotheses around those particular assets or underwriting frameworks so that when there is poor performance, we have the tools to diagnose it. And we know, Rob thought Facebook was going to, produce this much in earnings and have this sort of operating margin, and we're 3 years in and the operating margin is half of his expectation and the growth is very different. Not that we're ever going to be able to underwrite companies as well as our partners, but we're developing, points on the map in terms of how things should be playing out. And I think performance is ultimately an aggregation of a series of those decisions. And so we should be able to have a good finger on the pulse of what's working and what's not, and whether that's consistent with our expectations. Curious if you guys think about it differently, but we can save that for the panel.
I'd chime in there as well. I think it's because obviously I speak to a lot of endowments who want to underwrite me as a manager, and I can't emphasize how important it is to go down to the stock level to be able to at least form an opinion on the underwriting process of individual stock ideas. Otherwise, it's at a much too superficial level, the conversation. Stefan, I think you had a question. There's one there first. Sorry, Chandon.
Hi, Nate. Just wondering, how do you incentivize your managers to pick or your partners to pick the best managers for your funds?
How do I incentivize my partners in the sense of the people we're allocating capital to, or? Mm-hmm.
So your colleagues.
Right. How am I and how are my colleagues incentivized? It's over a longer time horizon than a year. It's not an eat what you kill culture where Nate has a P&L or Nav has a P&L. We view it through the lens of impact, and that might be impact to our assets. It might be impact to being a great colleague. So there's lots of different ways. I don't want to delve too much detail into the way the compensation structure has been built, but I think from first principles, it's about lengthening the time horizon and appreciating that it may take a couple years for something to really come to fruition and for the impact to emerge. And I think there's also a sense, are people contributors to a shared culture, which is a hard thing to evaluate quantitatively. But I think when someone is bringing a culture down and when someone is bolstering a culture up. And so I think we have a sensitivity to that, because the way we invest only works if the culture is durable and if everybody's rowing in the same direction.
Great. Sophia?
Thank you so much for sharing your story here today, Nate. My question's around young investment managers as you're looking to underwrite them and you back them. Typically, in your experience in backing young managers, what do you see as sort of common mistakes that they make, and how do you re-underwrite those mistakes when they happen, and how do you think about that? Thank you.
That's a great question. I think there's a handful. I think one, and Dan spoke about this last year much more eloquently than I can, is they start with too high of a cost base and then have to become a marketing machine, not an investing machine. And that's a real vicious spiral, where you have too many people, you're now a manager of people, not someone who's really focused. If the assets don't come in, you feel too much pressure because you have this big burn rate. Then you have to focus more and more time on marketing to fill the hole, and performance ultimately suffers. So I think people that start with a very lean and focused cost base is a huge advantage. Now that works in some places and not others. If you're buying a 10 or 12 stock portfolio, you can have a very lean cost basis. If you want to be a long short fund, it's a different construct. If you want to build a private equity business, that's a much higher day one cost structure, all else equal. And so that's one area. I think the other area we see is people don't take the time and effort to clearly articulate their vision on day one. And so when they start to go out to raise capital, they start to evolve their focus and their vision to fit what might be attractive to sources of capital, and they sort of weave their way to a message that is more attractive to more people, but ultimately diluted relative to what they really want to do. So I think that's another common mistake that we see people make. There's a lot more we can maybe talk offline. But yeah.
Okay, we have maybe one more from the room, then I'm going to finish up with a question as well.
Hi Nate. I would like to understand better what are the demographics of your portfolio of investment managers, of emerging investment managers. So how many emerging investment managers do you have now in your portfolio? How many of them would you like to underwrite in the next, let's say, 3 years? And what is the typical allocate? How does typically capital flow to these emerging managers? Are you starting strong and then add smoothly, or start little and then you invest significantly more? So I would like to understand all this.
It varies, and I think the details and the nuance to answer that question might be maybe a little bit kind of too close to the fold. We don't ever start the year with a budget of saying we want to hire this many people or we want to deploy this many dollars. It's much, much more opportunistic. And there could be a year where we do very little, and there could be a year where we do a lot because, things just hit all at one time. There have been circumstances where we've met someone over the course of 3 years until they're ready to, really launch off on their own. So it's highly, highly idiosyncratic.
So maybe I'll finish up with the last question. So I guess a lot of the people here today are probably rethinking their careers, hoping to start a fund, probably more on a kind of a stock picking track, I would guess. Maybe you can finish up by saying a few words on working in an endowment and taking one step removed from stock picking, more,
Sure.
picking managers. Yeah.
Sure. I suppose that a stock picker who invests capital on behalf of MIT and other remarkable universities and foundations could feel the same sense of satisfaction that I do. But I think it's very different when you're kind of walking the halls and on campus and seeing, day to day how the dollars are being redeployed into solving extraordinary problems that matter globally, that give, first generation students the opportunity to attend a place like MIT. So if you really want to be closer to the impact, I think being in this seat is wonderful. And I don't think you give up a whole lot, because we spend an enormous amount of time learning about companies and meeting the best investors in the world, reading their letters, having coffee in, far corners of the globe with truly remarkable thinkers, brilliant investment minds, but also extremely high integrity people that have lived interesting lives and have just great stories. And so being a part of that ecosystem is just a wonderful, wonderful way to spend time. And I want to finish where you started with kindness. I'm super flattered by that. I think it's extremely underrated in the world, and perhaps becoming more underrated through time. I think kindness is a really simple thing and can be deployed at much more scale. So I think
What a wonderful note to end on.